Hello, this is Mike Swanson. I run the website WallStreetWindow.com. And the odds are that you're watching this video because you got an email from me telling you that it's up. Now, if you're not on my free email list, go into the description and get on it, because then you'll get from me for free every single morning my trading updates and some more deeper thoughts than you can just get in a video. And plus a digest of all the key headlines you need to know about moving the markets. And we've seen some interesting headlines in the past week and some interesting market action. If you've been following me, you know that last year I was very bearish on the market. Every time that it rallied, I would say, don't believe the rally, don't believe the rally. You'll get stuck if you buy into it. But this year, my tone changed because I believe that we're not seeing a bear market rally since the beginning of the year, but a real rally, really the start of a cyclical bull market. That's not one that goes on for 10 years, but one maybe 2 years or so. But this is just the first couple of months of that move, which would have started towards the end of last year. And the move has been led first by breakouts through the 200-day moving average in Europe, emerging markets, gold, silver, and related sectors in the stock market that have to do with that. And then it flowed into the S&P 500 and the NASDAQ really beginning in January or towards the end of January when they moved above the 200-day moving average. But people have been very doubtful that this move is real because of all the suffering they went through last year. And that's understandable to be doubtful. And plus, the headlines are so uncertain when it comes to the economy. And we saw that last week. If you think about what so many people were predicting would happen if inflation, 2 years ago, they said it was transitory when it started, and then it proved not to be. And then the Fed had to start to raise rates, and they got more aggressive in raising rates. And then as this year came, a lot of people are saying that inflation would go down to a 2% annualized CPI. And we had several good months of inflation diminishing, just as people had predicted. But last week, we found that this did not continue in January. So let me show you those negative stories. And then we'll talk about how the market is actually trading anyway. But you can see this is just the most current headlines. Look, CPI did not go down as predicted last week. And now the Fed Fund futures are projecting not 2 rate hikes, but 2 coming, and a possibility 50-50 of another one in June. But we're still towards the end of this rate hiking cycle. And that's why the stock market is not going into collapse like it did last June when the inflation picture got so bad. Inflation running hot, not going away as we had seen. But we were told by some of the people that were bullish that, look, inflation would vanish really rapidly, continue to decline, and we'd hit a 2% CPI target within the coming months. And this data kind of really puts a hole in that prediction. But they were saying the market would rally, but the market is not falling apart, even though their predictions are wrong. And that's what you should really focus on. So when we look at the S&P 500, this is what's happening now. This is a technical chart. The indicator on the top is the stochastics daily indicator. When it gets above 80, it's an oscillator. When it gets above 80, it says overbought. And then when it crosses below 80, it generates a sell signal. When you're in a bear trend, as we were last year, those sell signals lead to significant declines. And you saw that happen from August to October, June into July, really April into June. And then we had a sell signal just 2 weeks ago. But I did a video when that sell signal hit saying ignore it. This is not last year. It's not the same market environment. And so sell signals don't lead to collapses. Instead, they lead to short-term dips or sideways consolidation phases to work off the overbought conditions. So that's what I thought we're headed, where we're going to see when I did an update 2 weeks ago and said the same thing last week. I'm basically saying the same thing now. And the fact is that the market has held strong, even with the negative news last week. And I take this as confirmation that, yes, this is not, the type of sell signal we saw last year, but a pause in the market, I still think the S&P should break through 4,200 in the coming weeks. I think 4,000 is now solid support. That's where the 50-day moving average is. Specifically, that's at 39.77. And then the 200-day moving average is at 39.43. You should consider that area between 39.43 and 39.77 now as powerful support for the S&P 500. And the thing is, though, when you look at this as a global financial system, not just S&P 500, not just NASDAQ, but a global financial system, you see that the real bullish action is happening outside the United States. And here is the ETF for Germany. I own a position in this ETF, and it rallied first before the S&P, stronger than the S&P. This went through its 200-day moving average in November, whereas the S&P didn't do that until really here at the end of January. So the action in German stock market has been leading the S&P by 2 months. And what happened here? Well, when it got overbought in December, you can see it had a quick dip and then broke out again right after New Year's. It got overbought again. And what's it been doing? Simply going sideways. The stochastics indicator gave a sell signal just a few weeks ago, and this has not dropped at all. Instead, it's drifting sideways. The 20-day Bollinger Bands are squeezing. This looks like it's in a position to break out and surge. So I'm bullish on this ETF. I own this ETF, and I think it's going to go higher before the U.S. stock market does. Now, let's take a look at gold, because gold had a little bit more of a dip this month than other markets, but gold went up more from November to the end of January. Gold went up more than the U.S. stock market. It went up more than the NASDAQ. It went up more than such things as the ARK ETF, and then it took a dip. And now, as I said in the last video update I did about gold, it is in a buy zone. Why do I say that? Look at the indicator at the top again. That is the daily stochastics. It gave the sell signal, but when they go below 20, that signal's oversold. Gold is now oversold on this indicator and other similar oscillating indicators. It's also in the buy zone I spoke of the other week. What's that buy zone? It is the confluence between two major support zones. Several major support zones. They are the 200-day moving average, which is at 1783, the 50% retracement level of the November low, and the most recent high for the price of gold. They're very close together. That's around 1800, and now gold is like, it went to a little bit below 1830 last week for a few moments, and it's around 1850 as I speak. I don't think it's going to just go straight back up to 1975. I still think it's going to go sideways, but this is a buy zone. And that's an exciting thing to think about when it comes to the price of gold. Now, I didn't draw the same thing on silver, but silver has the same story. $21 an ounce is support on silver. That's where the 200-day moving average is and the 150-day moving average. So, yeah, everyone is obsessed with the S&P 500, and I do own U.S. stocks, don't get me wrong, but there's better buying opportunities now for gold and silver right above $21 an ounce, and I think we can expect a nice move in European stocks coming up very soon. So overbought conditions are getting worked off. The market has held strong despite all the negative inflation news, and it is negative. Don't let anyone fool you. But that's, the macro environment and what the financial markets do are not always the same, or it's not, I should say, obvious why they're moving the way they are. That's why it's always so important to focus on the technicals and the charts and not simply what the economy is doing or what you think it's going to do. Because frankly, all these predictions of the economists almost never turn out. How many people were saying inflation's transitory? They were wrong. How many people have been saying to you, or were saying to you, inflation is going to go down very quickly this year to 2%? And it's in last week shows us it's not an easy move down to 2%. I frankly don't think we're going to get there, but that doesn't derail the stock market. And we'll see how things unfold. Now, I have a follow-up video I'm going to put up soon. And it's going to be more about the big picture, what the big macro event is that's really influencing things the most that you need to know about. And it's going to affect all these markets over the next couple of years. So to get that, you got to be on my email list. You get the email, or if you're new to my YouTube channel, hit the subscribe button, then hit the bell next to it, and YouTube will send you an alert as soon as that next video is up. And I'll be talking with you then.